Welcome to today's market report.
Global shares climbed on Wednesday as U.S. Treasuries rose and the curve steepened after the U.S. Federal Reserve, as expected, approved plans to begin scaling back its bond buying stimulus program this month and end it by June. The Pan-European Stock 600 index rose 0.35% and MSCI's gauge of stocks across the globe gained 0.45% as investors digested the decision taken amid a surge in inflation. Wall Street hit closing record highs, with the benchmark S&P 500 advancing 0.65%. The Dow Jones rose 0.29%, while the Nasdaq added 1.04%. The Fed also maintained its assessment that high inflation would prove transitory and likely not require a fast rise in interest rates. The 10-year yields, which fell to 2.5-week low of 1.519% earlier in the session, climbed to a session high of 1.602%. It was last up 4.2 basis points at 1.5893%. John Canavan, lead analyst at Oxford Economics, said while the wording in the Fed's meeting statement provided some acknowledgement of the uncertainty regarding the transitory nature of inflation, the central bank continued to espouse the transitory view. At the end of its two-day meeting on Wednesday, the Fed said monthly $120 billion purchases of treasuries and mortgage-backed securities would be trimmed by $15 billion a month starting this month, with plans to end the program in 2022. The US job market may have improved enough by the middle of next year to be considered at maximum employment, Fed Chair Jerome Powell said on Wednesday after its policy meeting. Officials did not see troubling increases in workers' wages that might raise the risk of a wage price spiral developing that could force the Fed to act sooner than expected to contain inflation. Better than expected third quarter earnings also have helped lift sentiment for equities. European Central Bank President Christine Lagarde pushed back on market bets on an interest rate hike as soon as next October, saying it was very unlikely such a move would happen in 2022. Fixed income investors are also eager to find out whether the Bank of England will on Thursday become the first major central bank to raise borrowing costs after the coronavirus crisis. The dollar index softened after the Fed statement, hitting a session low before reversing some of the losses and fell 0.26%, trading at 93.87. Ethereum, the world's second largest cryptocurrency, hit an all-time high on Wednesday, catching up with Bitcoin's rally and riding on news of widened blockchain adoption. US crude stocks and distillate inventories rose while gasoline inventories fell, the Energy Information Administration said on Wednesday. Crude inventories rose by 3.3 million barrels in the week to October 29th to 434.1 million barrels, compared with analysts' expectations in Reuters poll for a 2.2 million barrel rise. US crude recently fell 4.67% to $79.99 per barrel, and Brent was at $81.20 per barrel, down 4.15% on the day. Spot gold dropped 0.9% to $1,770.62 per ounce. GBP/USD was trading around 136.70 on the release of the Federal Reserve statement, where it appears that the board members are less certain that inflation will be transitory. Nevertheless, the price made a fresh high during the knee-jerk reaction to the statement and wider spreads. The range so far today has been between 136.07 and 136.86. Chairman Powell will now likely emphasize how tapering will lead to flexibility in responding if the economy evolves in a way that deviates significantly from expectations. He should be pressed on the change in the statement with regards to transitory language as well. Given there is no set detail as for the path of tapering beyond December, he will likely be questioned as to what the expected lines are going to be from there onwards and how fast he expects the taper to be until the rate hike lift off. Eurodollar was trading around 116 throughout the Federal Reserve events. The outcome was more or less in line with the market's expectation, narrowing the trading range for Eurodollar.
This is today's market news. Thanks for listening. We'll see you next time.